I also, this is the beginning of our actual um, PowerPoint and my teaching the nuts and bolts of this SIE. This is going to be about 24 slides. And by the way, one of the things we do is this is an achievable series. This is primarily made up from achievable dump sheets. Achievable is one of the vendors that we recommend, especially for the SIE. Achievable content with Kaplan Q bank questions seems to be a pretty unstoppable combination. So first things first, achievable. We got the complete teacher efforts and the different areas we're going to hit are capital markets, product risk, trading and accounts, and regulatory framework. The test itself is 75 scored questions. Okay. They're going to add 10 that are just like project questions or they're pilot questions, so to speak, that they might be trying down the road. You can't concern yourself with which ones they are. People are always like, "Oh, I think I got it, but I missed a 10." Like just you don't know what they are. Nobody knows what they are. You just don't count too much. Okay. The name of the game, here's the name of the game. The name of the game on this test is to actually know what it's about. Okay. If you can figure out what's actually on this test, if you can own this material and have an understanding, I'm not saying you have to be a guru or an expert or a whisperer or whatever it is. You just have to have enough to pass the test. The less you can use the little tricks and little things that I might mention as we go along, or you might see in other places, the more you can own this material, the better your chances are of passing. They generally allow you, they do allow you 105 minutes on the test, and in all honesty, that should be enough. If you have a grasp of this material, this SIE is not a test that has a big time factor to it. You should be able to make that one in time. Passing score is 70. Okay, now here's the thing, they do curve these tests, okay? But you're not going to know when, you're not going to know where. And people talk about, oh, I hope I get a good draw. I hope I get this. If you're prepared for the test, it's not going to matter much what they hit you with. And as I just said, they do curve these things. Okay, now you'll never know that it happened. You'll never hear about it, but they do curve them. And the four big content areas are capital markets, products, trading, and regulatory. This is on the SIE. This is your introductory test. Now, once you pass the SIE, there are no prerequisites. It's open to anybody who's 18 or over. As a matter of fact, I say to people, look, if you're in college or you're thinking about joining the industry, take the SIE before you even go to get a job. All right, because that's one step closer to being licensed than you were. And I do believe it shows a certain amount of intent and a little less training that the person who wants to hire, the company that wants to hire you has to do. So I recommend taking the SIE as an eight at when you're in college or just before you're going to, let's say you're going to get a job at an insurance company and you know that they're going to make you take some of these tests. If you can bang out the SIE before you get there, which is kind of be on your dime, but it's $60, but you don't need sponsorship. That's just one less thing you have to worry about as you're trying to be, do a job. Um, Co-sponsorship is not required by for the SIE, but to become a Series 7 or Series 6 or upgraded FINRA member, that will require you to have a job and to have a company, a BD behind you. The good news on the SIE is it's valid for 4 years, which is different than the other tests. And by the way, that's a question on the test. Okay. How many years is the SIE valid? And the answer is 4 years. So the SIE is valid for 4 years, as opposed to all the other ones, which are valid for two. And and on the other ones, if you leave the industry, you keep your license for 2 years. And then if you want to keep it for longer, you have to do what's called the MQE program, another thing from this test, where you pay FINRA a fee, you take the continuing ed and can continue with your licenses. But with the SIE is for no matter what. Now, this is interesting. This retaking, when you fail a test once and twice, as of this minute, as of today in this country, it's 30 days waiting it's 30 days waiting to take the test again. And then if you fail a third time, it was 6 months. That is about to change. Okay. That is changing probably at the end of this month, where it's going to be 15 days for each first two failures and then 60 days for the second. So any of you out there who are sitting on a 6 month probation, you may be about to get a reprieve at some level. So here is the content, the SIE content blueprint, so to speak. So the first thing we have is 16% of this test is on the knowledge of capital markets. These are economic factors and market conditions, types of market, primary versus secondary, very important. We'll talk about all that. And market participants and their roles. That's the broker dealers, the investment advisors, the market makers, the real estate, the regular brokers, the bond traders, the bond dealers. We're going to talk about all those kind of things. And then understanding products and risks. As you can see, the biggest portion of the test is actually called its suitability, right? Suitability, know your customer, right? That's what they're trying to get you to realize what the products are, how they're used, what they do. So understanding products and the risks, equity securities, understanding the difference between common and preferred stock, which we'll talk about, the different debt instruments and bond instruments. And that is what the whole test, stocks and bonds, right? But I will tell you this, bonds are a heavy part of this test. This thing has been called the bond test, so we got to watch it. Package products, these are open-end and closed-end funds, ETFs. Options and derivatives. Guess what? Good news, everybody. Tell them the good news. Tell them the good news, Mortimer. The good news is options and derivatives are not a huge part of this test. If you have the options basics down, you're going to be okay for the SIE. You do not need to spend weeks studying options for the SIE. Now, I will tell you that when you get to the Series 7, we're going to have a different conversation. But for the SIE, option to derivative is not huge. And alternative investments, just you got to kind of know what they are. Nothing amazing or fantastic. As far as understanding trading and customer accounts, a lot of the secondary market stuff. All right. Order types and trade execution, yeah, you're gonna have to be able to read, a quote. You're gonna have to be able to read a market. You're gonna have to understand how trades settle in sense of when they settle. You're gonna have to understand how, dividends and X dates and record dates and payable and that kind of stuff comes up. Margin or reg T, minimal. Like, I mean, we even kind of go, look, another thing, don't spend a lot of time or money on that. Okay. Don't spend a lot of time studying margins. Don't spend a lot of time studying options. It's not going to come into play. Okay. Account types and profiles, brokerage accounts that you want to get your hand around that stuff, right? The individual accounts, the fiduciary accounts, the custodial accounts, the custodial, all the different kind of accounts that we're going to go, and trade settlement and processing rules. That's definitely going to be a part of it. One little hack I'll give you, it says T plus one, trade day plus one is the main settlement. When in doubt, go T plus one. Like it's what is it called? Occam's razor, right? Is that the easiest answer, especially on the SIE, the easiest answer is usually the right answer. Okay. And if T plus one is there and you're not positive it's something else, it's usually T plus one. Also, the regulatory agencies, SEC, FINRA, MSRB, the OCC, all the different regulatory we're going to talk about and prohibited and practice in violation. But as you can see, not huge, but it's there. And frankly, this too is it's a little gray specifically on some of these, but they do suitability reaches across all FINRA tests. That is just the way that it rolls. Okay, next page that we have up here is primary market versus secondary market. These are two concepts that you have to get down. And what are we talking about with this? So let's start with primary market. What is this part of what this test is about? A big part is capital formation. Okay, corporations need more money, and they can do it one of two ways. They can either borrow the money, which is bonds or debt, or they can actually sell a piece of their business. And when they first do this, this is called a primary market transaction. So the number one thing that's a difference between the primary market and the secondary market transaction is who gets the money, who gets the do re mi, right? Well, in a primary market transaction, the issuer gets the money. And let's go, what the heck are the issuers, Mike? Well, the issuers are the U.S. government. The issuers are municipalities, states, counties, whatever, and companies. And why are they issuers? Because they need to raise capital to either grow or continue the operation that they have. And they're going to get the capital by getting it from by investors that investment banks are going to be bringing to them. So the primary market is the issuers, the ones I mentioned, government, municipals, companies are getting money from investors so they can enhance. And now there's two ways that they get it. As I said, first one, stocks. They're literally selling a piece of the company, literally selling a piece, literally giving you a capital stake in the company. Number two is they're literally borrowing it from you. All right, they're saying, "Hey, can I borrow $1,000 about it?" Yeah, they're formally saying, "Can I borrow?" Yeah, let me borrow $1,000. Literally saying, "Can I borrow $1,000?" That's par, and they're going to pay you interest. Now, the one thing I will say that we'll hit more on, bonds are not like your regular credit card. When you get a credit card or you get a mortgage and you pay back every month, you're paying back principal and interest. All right, bonds are interest only until the end. Okay. So in essence, a company or the country or a state or a municipality borrow money from you. They pay you back an interest rate, a fixed income, right? That's why we call it a fixed income over time. And then at the end, they pay you back the original money that they borrowed plus the less interest payment. That is without a doubt the way bonds work. So in the primary market, we have three big things that come up. It's not the only thing, but it's pretty close. Is an IPO, right? The IPO is the first time ever a company comes, first time the debutante company coming out, like SpaceX came out a couple weeks ago, right? And this is a company selling itself to the public for the first time. Up to that point, it's been private equity. The Silicon Valley boys are funding it. Yeah, we've all had our friends who go, I got tier one financing, tier two financing, and you find out, tier one was mom and tier two was dad, right? But this is like the big ones, okay? This is like private equity firms that are funding these companies. So let's take Uber, for example, back in the day. Uber was private for, say, 8 years, funded by private equity firms. Finally, they came public, and that is the IPO. That's the issuer that's the primary market when they first come public, either as a bond or a stock. Follow-on offering or an APO offering is that okay? So the first time, now don't forget, companies don't sell all their stock on the you know. So actually, when I think, do I have this right? When Musk sold SpaceX, he sold $78 billion worth of it, okay, which was say 10%, or I don't know what the percent was, but say it was 5% of the whole company. And then they value it. They go, oh, if they paid this much for 5% of the company, then the whole company's worth 2 trillion. Okay. So when you do an IPO, you're not selling 100% of the company. You're selling a percentage of the company. And then the follow-on offering is maybe you sell another percent and another percent, another percent. So you can constantly get new capital in. So IPO is the initial public offering. The APO or the follow-on is afterwards. Now, these primary market transactions, you have the issuer, and then you have an underwriter or an investment bank, right? The Goldman Sachs, the Morgans, the JP Morgans, the Merrills of the world. They One of their biggest ways they make money is they help bring companies public. They help bring companies to follow on offerings. They basically helping companies raise capital is definitely one of the most profitable things they can do. Um, the investment bank becomes the middleman between the issuer or the company or the government or whomever and the investor. And they get paid a pretty penny for that. Okay. Somebody's got to pay for those Ferraris, right? Prospectus required. This is true with all IPOs and APOs. Okay. IPOs and APOs all require prospectuses. And let's talk about how that rolls. If you do an IPO on an exchange, You have to give prospectuses to the customers for the first 25 days. That's NASDAQ or NYSE. If it's an APO, you don't have to, it's 0 days. If you do an over-the-counter IPO or APO, an IPO over-the-counter is 40 days. I'm sorry, an IPO over-the-counter is 90 days prospectus and 40 days for an APO. Okay, next. Let's go. Oh, let's actually talk about one other side thing. I've kind of one, I don't want to say it's in the middle because it's not, but it kind of is. There's a thing there's one of the problems with this word secondary is it gets used a lot in a short amount of time. Okay. So you have a secondary offering, you have a secondary market, and you have the second market. So this is one of the classic FINRA things is that they always come up with three words for the same thing and it gets confusing and it gets to be a little much, right? So let's talk about the first one. What is a secondary offering? A secondary offering is usually tagged with an IPO or an APO. So let's say that a Mark Zuckerberg or a Jeff Bezos decide that they want to sell their shares. And when they're looking to sell shares, they're looking to sell shares. Okay. So let's say they're going to sell a couple million shares. Well, if they went to the open market, if guys, back in the day when I was working, if I was in a stock and I found out that the founder was selling millions of shares in the open market, I'm going to tell somebody. And also, that's going to cause the stock to go down. So what they like to do is they like to tag their offerings onto other primary or APO offerings. Because let's say they're doing a 10 billion AP 10 billion share APO, all of a sudden their 2 billion doesn't sound like so much. Everybody can swallow it all at once, as opposed to open market. So you got your IPOs initial, APOs follow on. And then the secondary offering is if a shareholder or a founder or somebody big in the company wants to attach their shares, they want to sell their shares, they attach it onto one of these, and we call that a secondary offering. Okay, that's primary market transactions. And again, how do I know primary market versus secondary market? Primary market, the issuers get the money. Secondary market, the investors get the money. All right, so now secondary market. That is all the markets that trade anything after IPO is a secondary market, right? That's investor to investor, person to person, whatever it is. And that's who's getting the money, right? The investors getting the money at that point. So these are trading of already issued, already public issues, securities. Proceeds go to the selling shareholder, not the issuer anymore. They trade in exchange on the markets like the NYSE or the NASDAQ, or they trade over the counter. What is the difference with that? The exchanges are centralized places. They used to be that's where I used to work, right? What literally would go in every day and like there'd be 5,000 people on the floor. Now it's a little more computerized, a lot more computerized. It's more like a TV studio actually now. But the exchanges, New York Stock Exchange, NASDAQ, are considered central places where there's some form of an auction, a semi-auction market going on. There's a centralized market where people go. Over the counter is a conglomerate of a lot of traders upstairs on computers, different offices, um, trading back and forth. They're not actually in one central place at all. The exchanges, generally speaking, get the higher except with some exceptions, the the exchanges get the higher level companies like the billions and billion, the more stable companies, and the over the counter is more of the newer companies or the smaller companies. FINRA regulates broker dealers in the secondary market. Who is FINRA? FINRA is a self-regulatory organization. They are not government owned, but they used to be a pseudo government owned thing. They were New York Stock Exchange and NASDAQ together, but they're not anymore. So now FINRA is a self-regulated organization that regulates secondary markets. Now, don't forget, we're going to talk about regulatory agencies later. SEC is daddy. That's the government-owned overseer of everything. FINRA is kind of like the vice principal at the school who runs all, he does all the day-to-day stuff. They have this, you remember when you're in school, the principal wear the suit with the shoes. You knew the vice principal because he had the sneakers on because he had to go chasing everybody else. FINRA is definitely the vice principal. They're the ones who are chasing down people. But one other thing, there's two acts that come up all the time on this test. It's the Securities Exchange Act of 1933 and the Securities Exchange Act of 1934. The Securities Exchange Act of 1933 deals with the primary markets. Primary markets. The Securities Act of 1934 deals with the secondary market. So one of the things that's tricky, which I'll hit up later also, is the Securities Act of 34. So these guys, what it was came down to is that so in 1929 the market crashed and caused the Great Depression. And the 20s were like just a wild west. Actually, up until the 20s, the exchange was a wild west crazy day. You could do whatever you want, or their brokers called it the good old days, right? So, and finally, after 4 years of depression, the um, powers that be on the financial world finally agreed to allow the Pecora Commission come in and create some rules so that they could try not to have another depression or another crash. So 1933, the first thing they worked on were the primary market transactions. The first thing was the primary market transactions. That's the SEC Act of 1933. And the secondary market transactions came in 1934, investor to investor trades. And now here's the kicker. So what year do you think they created the SEC, which is the police, right? 1934, right? They wanted one more year of the good old days before they could go in there and before they could go in there and actually have a police. So this whole year they made all these rules without a cop and then finally came up with the cop later. First thing we're going to talk about as far as raising capital for companies goes, for issuers, is common stock. What is common stock? Common stock is literally the issuer or the company or is giving you a piece of them. Now, don't forget, it can only be a company. The government cannot sell itself. Seems like lately that's not entirely true, but we're going to stay with that for this test. The government cannot sell themselves. Only a company can sell themselves. They can literally sell ownership. So common stock is an issuer saying, look, we're going to sell 10% of our company. We're going to raise capital by selling a piece of our company. Just like if somebody owned a store, a bakery, and they said, look, we need some cash. We're going to have to sell 50% of the bakery to raise some cash so we can afford to keep doing this. That same idea. Okay. So, in theory, if you buy Amazon, you're a 0.0000001% owner along with, the difference is Jeff Bezos has $300 billion worth and you have 0.0001. Quick Jeff Bezos side story was that back in the early 90s, he was actually a trader at a hedge fund and or an analyst possibly, but slash trader. And he his story had gotten around that he was going to build a online book company in his garage. I'm sure that's like a little exaggerated, as all stories, if you know anything about Wall Street, all stories are exaggerated. But that was a story that went around. It was like, aha, this guy building what a maroon building he's gonna do a bookstore in his garage. Yeah, I guess who got the last laugh on that? So I think looks like things worked out for him. So let's go back to common stock ownership. This is ownership is a residual ownership of the company. It represents a proportion ownership in the company that we get. You own a piece of it. Now, what that gives you is voting rights, right? For every share you have, you get one voting right. For every share you have, you get a voting right. That means you can go, and that doesn't mean that you vote for every decision that comes up. It's not that. It's that you can vote for the board of directors and any big things that go on in the company. They're supposed to bring it to the to the board meetings for you to vote on. So one share equals one vote on corporate matters, and then they have two different kind of voting rights. One is cumulative, one is statutory. Probably want to look at that deeper in a video. Maybe I'll do later with this, but cumulative basically says you could take say there's 5 items on an agenda and you have one vote, one share. So you have one vote for each item, right? So that gives you 5 votes. You could actually in cumulative take all 5 of your votes and put it on one item. Okay. Where statutory is you'd have to vote each item one at a time. And just the bigger note to understand is that cumulative voting favors smaller shareholders. Statutory voting favors institutional shareholders. Next, let's talk about dividends. Where did dividends come from? Dividends come from earnings, bottom line. So if a company earns say $5 in the year and they decide to send and they want to send that to their say they want to send $4 to their shareholders, they send $4 in dividends. Okay, maybe quarterly, a dollar every quarter. The other dollar we call retained earnings. Okay, so earnings are where we get the dividends from. And the amount that they pay out compared to what they keep in retained earnings is the dividend payout ratio. There's two big kind of stocks they talk about a lot that you got to have down: a value stock or a growth stock. Okay. A value stock is usually like an older company, okay? Established, makes a crap ton of money still, like a FedEx. FedEx has the whole world gridded out, and FedEx, we don't need any more FedEx offices, okay? But they still make they still probably make 5, 7% a year or whatever they make. Well, they don't need money to grow with. They're a value stock. So what they do is they pay all their money out in dividends. So if they have $4 in earnings, they're probably paying $4 in dividends. Also, their price earnings ratio is going to be lower. Okay. The PE on a value company is probably going to be below 10. What that means is that people aren't speculating on that company. They don't think it's going to grow a lot. They're going to own it. They'll take their dividend. They're happy, but they don't think it's going to go. Now, a growth stock is the other way. A growth stock is some new idea, some smaller, probably a small company, but a newfangled idea, trades at a sky high PE. Just so you know, like Tesla, the electric company that still hasn't made any money, is losing money, trades at I think 300 PE. That means that it's got to trade 300 for 300 years of earnings before it catches up to the stock price. Now, what happens is they're hoping that it'll hit big earnings and eventually that number will come down. Like at one point, hard to believe but true, Amazon didn't make money for I think 15 years. The first 15 years of Amazon, they were making no money, was trading at a sky high PE, and the valuation was insane. And obviously by now it caught up. And I think now Amazon's probably at like a 30 PE, if give or take. I'd have to look. But dividends also are not guaranteed. The board of directors decides whether or not they're paid or not. And that's one of the big differences between bonds and dividends, okay? Dividends are not guaranteed. They're paid at the pleasure of the board of directors. And one other thing is that qualified dividends, which are most dividends except REITs, are taxed at a capital gains rate. So because of that, two things are true. Stock dividends actually are tax advantage over bond interest because bond interest is taxed at an ordinary income level, but dividends are going to get a higher rate a lot of times because they're not guaranteed. The board of directors could decide not to pay them. Also, common stock last in liquidation order, right? So let's say that the proverbial, you know what, hits the fan, okay? And if you see here, this is the order of liquidation. Okay. So this is if things hit the fan and they're about to liquidate the company, bankrupt the company, gone, sayonara, no more. This is who gets paid first. Secured creditors. Secure and no, you got to know this, and this is going to be on the test. Okay. Secured creditors are creditors that have collateral. So secured creditors they get paid first. Whatever money's left, they're the first one to get it. Next, we go to unsecured creditors. These are also known as debentures or general debt, general creditors. Okay. And again, remember that word debenture. Debenture is a long-term unsecured corporate bond, also known as funded debt. Definitely coming up. Preferred shareholders are preferred shareholders. This is an equity, and we're going to talk about this a little more, but preferred shareholders are really a fixed income product. Okay. And they do get paid above common shareholders. Literally, common shareholders who we're talking about here, owners, they're the last ones up if anything's left. Generally, they don't get anything. Right. If you're a common shareholder and your company goes bankrupt, you're SOL. You're not going to nothing's happening there. So common stock has a higher upside, but a higher risk in liquidation. Heavily tested concept. They say it right here, right? They're saying that this liquidation priority thing is heavily tested on the test. So I would advise that you understand that and know that order. So next, we're going to talk about preferred stock and common stock. These are the two different kind of equity securities that exist. Preferred stock is tricky, okay? Preferred stock is an equity, but there's no voting rights and it has a fixed dividend. This is a fixed income product, okay? Literally, it's going to, and generally speaking, it trades at what we call $100 par and say it's a 5% dividend that pays you $5 per year. That is the money that you're getting from this. If as far as investment objective goes, and income is the investment objective for preferred stock. It does have a priority, as we stated earlier, right? In the liquidation wheel, the preferred stock does have a priority over common in dividends and liquidation. And also in dividends, right? So there's a couple different kind of. We're gonna hit that as we go along. No voting rights. Now, preferred stock have several different kind of preferred stock. A little bit tricky, but once you kind of know what they are, you get a clue where we're at. The first one are cumulative. As you can see, the first one is the cumulative preferred stock. What that means is, now if you remember, I said that board of directors can pay or not pay dividends at their pleasure. Okay, so let's say the board of directors decides not to pay dividends for 2 years. It's something they can do. Well, on that third year, when they finally want to pay common shareholders dividends again and get back in good stead, first things first is they got to take care of the cumulative. They got to pay them in arrears. Okay. So the cumulative stockholders have to be paid in arrears of any missed dividends. It's not negotiable. Non-cumulative, if it's a non-cumulative bond preferred stock, then the people who have the non-cumulative, if there's missed dividend, they don't get the dividends in arrears. They do get paid the year they decide to pay again before the common shareholders, but they don't get the dividends in arrears. Next, we have convertible. Convertible. This not doesn't mean that the top goes up. Okay. The convertible means that you can convert this asset into common stock. You can convert this preferred into common stock. And there's a whole math thing that goes along with it. I'll probably do that on a separate video at some point. But convertible stock has what we call a capital appreciation component to it, right? Because preferred stock generally is an income product, but because it can convert to common, it can convert as a secondary capital appreciation. Also, participating, what is that? So let's say that I get a preferred stock, it's a 5% payout, which is $5 per year or whatever it's going to be. But it says it's a participating. If the company does really well, you get an extra dividend. You get a dividend kick. So again, there's a little bit of a capital appreciation or capital gains aspect to it above the regular fixed income product. That's participating. Now, out of these, here's the other concept you want to get down, and stays true through all fixed income products. If the issuer gets something, they have to pay the investor more in return. If the investor gets something, they have to accept less in return. So with that being said, a cumulative preferred is going to pay less than a non-cumulative. Okay. A participating is probably going to get the least dividend because they're giving you extra, and the convertible will get more than a convertible will get more than we got bounced around here. We're okay, everybody. And the convertible so in order, I would say it goes participating from low to high, participating, cumulative, convertible, non-cumulative is probably about right, give or take. But just know if the issuer gets something, they have to pay the investor more. If the investor gets something, then they have to take less. Also, callable bonds. What does that mean? Callable. And here's the thing to remember. When the interest rates fall, expect the call. When the interest rates fall, expect the call. So if you were a preferred stock issuer and you're paying 5% a year to your investor, and all of a sudden interest rates around the world are going down, which means you could reinvest, you could refinance at a lower rate. What you're going to do is, if you can, you're going to call the preferred stock or the bond back, whatever the fixed income instrument is. You're going to call back that 5% bond, just like you would with your mortgage, right? If you had a 7% mortgage and suddenly get a 3% mortgage, you're ending that mortgage. You're going to go get the 3%. Same thing here. Okay. A callable preferred or callable bond is just the issuer's option to call it back. Now, again, remember what I said, when interest rates fall, expect the call. They're not going to call it back if interest rates are up. They don't want to pay more. They're only going to call it back if interest rates are lower and they can refinance. Okay. So now let's head over to common stock. Dividends are varied and they're discretionary. They can change year to year, they can change quarter to quarter. Depends on the earnings. Remember what we talked about. The dividends are based on the earnings. And the board of directors can pay them or not pay them. There's nothing guaranteed about them. Again, voting rights, one share, one vote. If you have a share of a company, you get a vote. You don't get to vote on everything, but you get to vote on the big stuff. Board of directors, change a company, different kind of stuff like that. Just like there's a list of things you do when you don't vote on. One thing you never vote on, dividends. Board of directors determines dividends. You can't put the inmates in charge of the asylum, right? Because if they let the shareholders vote on the dividends, we'd vote for 100% dividends every year, the whole thing. Let's go, just pay us, pay me, pay me, pay me. Um, and as we said, common stock is last in liquidation. But so what? So why in the heck would you buy stock? Because it's the most growth. Okay, the most growth potential comes from stocks. As a matter of fact, the other part is the best hedge against long-term inflation are common stocks. Okay. So think about that. Fixed income, not a great hedge against inflation. If inflation goes up and you're stuck at getting 4%, that's going to be a problem, right? If you have a common stock, though, you could get 10, 15%, 20%. So again, common stock are the best hedge against long-term inflation, not against short-term. Short-term inflation is no good. Generally speaking, common stock in this country, on this test is considered to be like 5 years or more. That is your time horizon for common stock, 5 years or more. Again, there's a liquidation priority they put up twice now. Might want to take that hint that that's a pretty big thing. And so, as we said, preferred stock acts more like a bonded behavior. It's a fixed income, has priority, limited upside. Common stock, variable dividends. You do get voting rights, and it has the greatest potential to go up. So now we're going to talk bonds. We're talking bonds. We're talking debt. Okay. So remember what I said earlier was that what are bonds? Bonds are the investor loaning money to an issuer. This could be the U.S. government, municipals, or companies, any of those. Okay. And the issuer is literally borrowing money and promises to pay back the principal and the interest. Now, as I said earlier, your credit cards, when you get a credit card, you're generally paying principal and interest all the time, right? If you're making monthly payments, that's a combination of principal and interest. It's like a hybrid, so to speak, right? These are not like this. These are more like interest only loans, okay? So in this case, the bond, let's say this when they borrow a face amount, which is in this case $1,000. And by the way, the default number for par or for money that you borrowed is $1,000. But that doesn't mean it's the only par. Got to keep your eyes open on this, okay? Because it makes a big difference. But if you don't get a par value, if they don't give you a number, assume it's $1,000 on bonds, $100 on preferred stock. Okay, $1,000 par on bonds, 100,000 preferred stock. So par. So this is me borrowing $1,000, and the coupon, which is a fixed percentage. Also, by the way, coupon is also called nominal yield or stated interest because once again, God forbid FINRA would name something one thing, right? So coupon, nominal, stated interest. That's the original percentage of the bond. When a bond is issued, generally issued at $1,000 par with a coupon of a percentage. So let's say it's $1,000 par with a 5% bond, that pays $50 a year. And two bonds generally pay in semi-annual every 6 months. The bonds pass 1 year or not zero coupons pay once every 6 months, usually like January, July, or February, August, or whatever the hell it's going to be, right? So, so bonds pay face value par. click. It's the percentage of par is that's how you get the interest income that they pay every year. So then as we said, the coupon rate or the nominal rate or the stated rate, that's the annual interest percentage. So you take that and you divide it by par and you get the actual money that you're going to be getting. Okay, now, as we said, the principal in this case, which is $1,000, doesn't come back till the end, maturity date. Whatever the last date of the bond is, you get back par plus one interest payment, which would be for 6 months because they get paid every two. Now, the market price fluctuates because market prices fluctuate daily because interest rates fluctuate daily. So once the bond is set, that's the bond. 5% bond, $1,000 par, pays $50 a year. Boom. But now that doesn't stop the interest rate market around it from changing, right? So all of a sudden interest rates go up, bonds go down. See this? Interest rates go up, bonds go down. Bond price goes up, interest rates go down. It's an inverse relationship between the price of the bond and the interest rates or interest yields are going to pay. A premium bond is a bond that trades above 1,000, trades above par. So in this case, it's $1,000, so we'll stay with that. But a premium bond is a bond that trades above par. A discount bond is a bond that trades below par, or in this case, $1,000. So a bond that trades at discount is a bond that trades below $1,000. A par bond is a bond that trades a bond or efficient market bond trades right on the number, right on whatever par is. Bond price and interest rates always move in the opposite direction. Always. Inverse relationship. When rates rise, the bond prices falls. When rates fall, the bond prices rise. Also, I'm going to add one other thing. Bond market prices are most volatile the longer distance, long and low, we call it. Okay. If a bond is a lot of years, the more years a bond is, the more volatile the interest rate and the pricing is. The shorter amount, the less volatile. And that's true with all investments. The longer the investment, the more volatile, the lesser the investment. Think about this. Like if I said to you, you know where you're going to be a month from now? For the most part, people are like, yeah, I know where I'm going to be a month from now. I hope anyway. But if I said to you, you know we're going to be 30 years from now? I don't know. I don't know. I might not be alive in 30 years. Who knows, right? So we go same thing with bonds. Okay, a 30-year bond, we don't know where it's going to go. We don't know we don't know how where that bond's going to go. So long and low, long bond volatile, and then if the bonds are the same year, the lower coupons are more volatile.